What did I say? I think I said that every deal was a little scary, $400 million market order. I didn't dollar cost average. I bought and sold everything at once. This guy was living on his Model 3 because he had nowhere else to go in early 2016. He left at age 39 in 2021 with $12 million in Tesla stocks. How did he do it? Today, we're going to break down Jason DeBolt's winning Tesla plan, which made him $12 million in less than the late years. We'll also show you how Tesla bulls can use his methods to retire early as well. And if we really want to use the DeBolt method, how often and when could we buy? How many shares do we need to buy to be able to retire and drink Mai Tais in Honolulu? Watch to find out, but first, please like and follow. In early 2023, he sold his house to buy another 10,000 shares. Bolt started out with just 7,500 shares that cost him $2 in April 2013. Now he has 48,000 shares, 50 a share at the time, a 19000 initial investment DeVolt studied business economics in. Grew familiar with concepts such as game theory, compounding opportunity cost, and supply-demand key ideas to his investment strategy, as these tend to support long-term and exponential positions. While the Bolt's concepts sound complex, his strategy was quite simple. His technique can be summed up in two basic principles: one, buy at every opportunity, and two, never ever sell. The second of these principles, never ever sell, has made the Bolt famous even today, as young retiree DeBolt makes headlines as the Tesla multimillionaire who refuses to cash his lottery ticket, having never sold Tesla shares for a profit that this principle would be tested early on for. The Bolt is 3 months after his initial April 2013 investment. Tesla stock more than doubled in price from $30 to $80 a share. This figure is pre-5-to-1 and 3-to-1 split, as his friends and family advised him to sell. Each new Tesla stock acquisition got progressively scarier, but he held on, buying an additional $12,000 in May 2013, 150 pre-split shares, and $82 in ND. $1,000 in November 2013, 142 shares at $141 pre-split, and $26,000 in March 2014, equaling 111 shares at $235 a share. What would it look like if you employed the Bolt's 2013 to 2014 never ever sell strategy in Tesla today? What could the results be over, say, the next 4 years between April 2013 and March 2014? The Bolt purchased $7,700 worth of Tesla stock. This signified a substantial portion of DeBolt's base salary, which at the time approximated $105,000 after taxes. One could say that the Bolt devoted nearly 100% of his annual net earnings on Tesla stock that year. The median net salary in the United States is around $46,000 a year. What would happen if you, making $46,000 a year, decided to go all in this year and invest all of your net proceeds into Tesla stock, much like the Bolt did between 2013 and 2014? Musk's stock price is $188 right now. Right now, $46,000 worth of Tesla stock would get you about 245 shares. How much will these shares cost in 4 or 5 years? Many people have made statements, but let's start with ARK's big guess that Tesla could sell for $20 in 2027. 7 million cars by the year 2027. If each EV sells for $26,000, Tesla will make $528 billion just from those sales. Since the basic Model 3 costs $42,990 right now, the average price of $26,000 suggests that Tesla has a great handle on pricing and is making great use of its profit margins. But ARK's model says that Tesla will make more money from Fs than EVs. It predicts that the company will make $613 billion a year from self-driving ride-hail. If Tesla made this much money, its gross margin would be 52%, and its overall EBITDA margin would be 34%. ARK thinks that Tesla's market value will be over $7 trillion by 2027 based on its phased-1 predictions. It should be worth $9 trillion, and each share should be worth $2,500. How does this compare to DeBolt? The Bolt's comeback in 2013 to 2014. They put $77,000 into about 12,000 shares after the split, which are now worth over $212 million. That's a return of 28 times their investment. But remember that this return is based on 10 years, not the 4 years that ARK says will happen in 2027. But if we really compare the last 4 years, we only get 3 times for DeBolt, since Tesla stock prices only went up 30% from 2014 to 2018. Your upside, should ARK's bold projections be realized, would be much higher. Your 245 shares purchased in mid-2023 for $46,000 would be worth $6,12500 by 2027, an astonishing 13 times return in 5 years, or less when projected over 10 years. ARK's bold projection would be on pace to even out to the Bolt's 28 times incredible return. If you think that's too optimistic, listen to what DeVolt himself had to say when he sold his house in early 2023 to buy more Tesla stock. Tesla is the next Tesla. This company is just getting started. We might not see a company like Tesla in the next 50 years. DeVolt believes there are huge gains still to be made, and that it is relatively early in the Tesla stock investment game. The opportunity to buy into Tesla with a never-sell mentality may still be available to us investors in 2023. Let's move to the other integral component of the Bolt's winning strategy. Don't wait, buy at every opportunity. Keep watching for projection of how your portfolio would look like once you employ all of the Bolt strategies today and seize early retirement. The end result is crazy, and you don't want to miss it. The principle of creating buying opportunities might be the riskiest and most controversial portion of the Bolt's playbook, and it involves something called margin. Margin is the practice of borrowing money from a broker to purchase securities such as stocks, bonds, or mutual funds. The investor typically pays a portion of the investment amount known as the margin, while the remaining portion is borrowed. Margin allows an investor to purchase more stock, but comes at the risk of merging calls. When you borrow on margin, the broker who lends To you, the money requires that you maintain a certain ratio between the account's equity and the total value of the assets held in the account, at least 25 or 30%. The risk is that market fluctuation can diminish the total value of the assets, which could bring your ratio below minimum required levels. In these cases, brokers will demand additional funds to maintain the ratio in a process famously called margin call. Failure to meet a margin call may result in the broker liquidating your stock to cover the losses the Bolt employed margin beginning in 2014. It's important to remember that Doubles last bought Tesla stock with cash for $26,000 in March 2014. Incredibly, that same day was also Bolt's first purchase of Tesla stock on margin, an incredible $82,000 worth of stock on one go. That was an extremely aggressive move for Bolt, as his stock portfolio, then consisting of about 12000 Polk split stock, was only worth about $180,000. His 82000 margin purchase left the portfolio with a margin maintenance level dangerously close to margin call territory, but he was just getting started on margin after taking a long break. On September of 2015, DeVolt transferred his Vanguard 401,000 into a self-directed 401,000. After liquidating his Vanguard 401,000, DeWalt was left with around 25000, which he immediately threw at Tesla stock, purchasing 1000 shares on one go. DeWalt strategy in liquidating his 401,000 proved a genius calculated move. 1 month later, on October 2015, Bolt purchased another $120,000 worth of Tesla stock, about 600 shares at 200 share, entirely on margin. The Bolt bootstrapped to the 1,000 shares from September 2015. Collateral allowing him to request additional funds from the broker to purchase another 600 shares a month later. At this point, the Bolt was certain that Tesla was just about to have a major break, thinking that these would be his final opportunities to buy the stock this cheap. Bolt did the unthinkable. He declined to renovate his lease and become homeless, living on this Tesla Model 3. Bolt lived in his Model 3 for about 6 months so that he could invest any rent money he saved in Tesla stock. He used his employer's offices for food, bathrooms, and other needs. Bolt says this helped him accept that he is willing to risk everything when it comes to Tesla stock. You see, he had shown himself that the little Tesla had everything he needed. If things got hard, he could go back to living a simple life. Every investor can learn something from DeBolt's run for homeless. It shows how to be brave and manage your hopes. In April 2016, DeBolt made 2 big purchases worth a total of $10,000. He put the $15,000 he saved on rent right into his next purchases. Then he doubled and tripled his savings, and in 2017 he bought an amazing $330,000 and $300,000 in 2018, all in credit. But on October 9th and 10th, 2018, his plan began to fall apart when his bank, Fidelity, raised their margin maintenance requirements without telling him. To meet Fidelity's margin call, Bolt had to sell all $70,000 worth of Tesla stock at once. There will be 5 more calls like this between the fourth quarter of 2018 and the first quarter of 2019. Even though there were problems, the Bolt had bought enough shares to become a multimillionaire by the time Tesla stock started its crazy rise in late 2020. These fringe calls would be the last ones he or she makes. It was clear that Dean Bolt wasn't fully ready to spend wisely on margin. He lost about 4,000 shares, which is equal to $4 million at Tesla's peak value, because of his margin mistakes. Bolt's buy at every opportunity attitude can still teach investors something. Come with me as I talk about how the average investor could use Bolt's margin tactics. Today, the average person makes $46,000 a year. If they put that money in Tesla stock, those 245 shares could be worth $612,500 in 27. We assume that that person also has an average 401,000 account and is 40 years old. The average 401,000 account balance at the age 40 is around $90,000. Now imagine that you pulled a Bolt and liquidate your 401,000 in order to buy Tesla stock in a self-directed 401,000. Those $90,000 would earn you another 489 shares, double the 245 you purchased with your annual salary, and would leave you with a grand total of 734 shares worth $135,000. But this is where margin comes in. What would happen if you were to go all in an employee margin on your $90,000 401,000 funds instead of buying the shares cash? Typically, margin agreements allow you to borrow up to 50% of the purchase price of new marginal investments, allowing you to buy double the amount of stocks. Compared to using cash, only borrowing 50% would be the riskiest scenario and would open you up to potential margin calls, because this ratio is close to most brokers' maintenance margins, which typically require that your equity not fall below 30 or 40% if the value of Tesla stock falls in. You purchased at 50 margin, then your equity could fall below those numbers. Another catch is that your broker could change the maintenance margin on you at any time. And in a scary moment as in the recession, it is possible that they arbitrarily set even the 60% equity requirement. With that said, 50% makes for simple examples. So we'll assume you're a massive risk taker and use the full buying power available to you. This is where things get interesting. If you were to employ the $90,000 from your 401,050 margin, you would be able to purchase $180,000, 50% on your cash and 50% on the cash lent from your brokerage, for a total Tesla stock investment of $226,000, which would get you around 1,221 shares today. You could also then leverage the 245 shares you purchase cash with your annual earnings of $46,000 to get more stock you can borrow against them at 50%, allowing you to buy another $23,000 worth of semicolon talk bringing your total Tesla investment to $249,000, which would get you about $1,300 in fact. 45 with $90,000 borrowed from the brokerage in connection with the $401,000 funds, and $23,000 borrowed in connection with your initial purchase of 245 shares. You would owe your brokerage $113,000 whilst holding a stock portfolio worth $249,000. This signifies a 45% maintenance margin, a dangerous maintenance margin by any measure, whatever dangers may exist by taking on such high margins. The gains on Tesla stock could also be exponentially higher. Suppose you use your $90,000 $401,000 funds to buy 489 shares cash. Then suppose ARK Invest Bolt projections were realized. Your 489 shares would be worth $1,222,500 in 2027. A gain of $1,132,500 after taking out the initial investment of $90,000. We've already talked about what would happen if you used a 50% spread instead. You could buy 978 shares instead of 489, and they might be worth $2,450,000 in 2027 if ARK's bull production comes true. $2,300,000 added, which is more than twice the amount won in the first game. If we take out a margin loan, it's the same as taking out a loan that needs to be paid back in full. So we need to take that interest payment too. If you make the minimum monthly interest payment and assume the interest rate is 8%, the total amount of interest you would pay over the 4 years from 2023 to 2027 would be $27,200. When we take out the interest costs on the $2,350.00 gain, our $401,000 margin account has a net gain of $2,325,870. We still made a lot of money, more than twice as much as we would have on cash. Most investors could walk away with $2,938,000 if they add the $2,355,000 gain from their 401k to the $612,500 they got from buying 245 shares based on their pay. They could get $2,192,390,000 if they used the Bolts method and saved a year's pay. We want to stress once more that this is the best case situation, which is based on a lot of good assumptions. On the other hand, we think that there won't be any margin calls because of changes in the market from 2023 to 2027. Still a $3 million retirement with an initial $136,000. Investment is a huge upside and one that rarely comes about without the extreme determination and commitment that characterized a Bolt from 2013 onwards. Now into the real juicy question: when a Tesla stock portfolio worth $3 million in 2020. 7 allow our hypothetical test a hero to retire large and large in a first world paradise such as Honolulu, Hawaii, with the Bolt's technique suffice to fund all those overpriced Mai Tais and margaritas. The answer appears to be it depends. It depends on what you do with your $3 million. Devil to true Tesla believer has chosen not to liquidate Teddy any Tesla shares and is instead living off a margin loan. In early 2021, the Bolt tweeted, "Soon I'll be able to merge and borrow about $3 million at less than 1%, but I will probably only borrow up to 8% of the value of my liquid assets." This